On the Federal Reserve and some big takeaways that we want to pay attention to, including some big changes. The Federal Reserve just released their latest policy statement and held their last press conference prior to the election. Yesterday, I mentioned that I would expect Jerome Powell to strengthen his verbiage on stimulus, pressuring Congress to get something done, and either keep the Fed's support for the markets the same or strengthen it. Well, the Fed did a form of both in various different ways. Here's what we learned. First, the Fed stated that there are considerable risks to the economy over the next 2 to 3 years. He really painted this picture of an economy that's going to take a lot longer to get back to normal. This actually led stocks to somewhat start selling off a bit. It wasn't as ideal as what the markets wanted to hear. The markets really wanted to hear, hey, Super V. Well, the Fed wasn't about to tell us that. Instead, the Fed told us that because the market is going to take a longer period of time to get back to normal, the Fed now expects to keep interest rates almost at zero almost entirely throughout 2023. This is a huge shift. Previous estimates held that the Fed would raise rates right around the end of 2022, beginning of 2023. This chart has now been updated to essentially say we're expecting rates through the end of 2023 to be zero. That means zero Federal Reserve rate for 2021, 22, and likely all of 2023, and honestly, it could even go on before or beyond that time frame. The Fed is doing this to try to push up inflation, but during their press conference, Jerome Powell explained that inflation takes much longer to come back up. It's not like it's something that suddenly slaps you in the face. Oh crap, hyperinflation. No. In fact, Jerome Powell does not actually believe we'll see 2% inflation until at least 2024. Until we have maximum unemployment, which we probably won't see maximum unemployment until 2023, according to the economic projections the Fed released. And Jerome says it's not just about unemployment, though. We have to see maximum employment, and we have to see maximum demand, and then we'll start to see inflation slowly come back. But both of those could take until 2024 or longer to actually be reached. He further explained that the Fed will not pull out the rug from under us as soon as we hit 2% inflation either. That's been sort of a fear that, oh my gosh, what if we go into an eviction crisis and a foreclosure crisis and all of a sudden, ding, we hit 2% inflation and boom, they pull the rug out from under us. Well, Jerome Powell gave us some more clarity on this today. We already know they have a new policy that's called the Flexible Average Inflation Targeting Policy. We just call it FATE for short. And Jerome says that rates and accommodative policies will continue until the economic recovery is well under its way, which we've heard him actually say that phrase before. But in questioning, he doubled down on this. And he was later asked again, how long are we going to support the economy? And he said, with emphasis, support will remain until we are far along in the recovery. He put emphasis on far along. That's even more aggressive than what we've heard him say in the past. So he's really kind of giving us these tells that, hey, the Fed's not going anywhere. We're not pulling the federal support out from under everyone. And when I say federal support, I mean the Federal Reserve support, because technically they're not part of the government. We know that whole game we see in the comments all the time. But anyway, the Fed to me here is being extremely clear. We're not expecting inflation. Inflation doesn't just pop up. Even if it does pop up, we're not going to pull the rug out from under us. And none of this is probably going to happen until 2024. And the best predictor of us having inflation is actually us getting our unemployment rate down. And they think we have to get down to 3.5% to 4% unemployment for us to actually start seeing meaningful inflation. So in other words, the Fed's here to stay for a while. On stimulus, Jerome reiterated that we can only lend. We can't spend, and the fact is only Congress can spend, and sometimes people don't want to borrow money or businesses don't want to borrow money. Instead, people will need more fiscal support, including renewed unemployment pay and other stimulus payments. And these are his words. He says he believes that private forecasts, the majority of private forecasts, expect another stimulus package. And he went on to say that multiple members of the Federal Reserve Board expect another stimulus package to come. In fact, Jerome went as far as specifically saying that if we do not see another stimulus package, which we're expecting, there will be, quote, considerable downside risks that will lead to evictions and foreclosures and badly scar our economy. That's pretty blunt, pretty blunt statements here on stimulus, pretty blunt statements here on interest rates, on inflation. These are all things we got to put together for our investing mindset for the next 4 years. I mean, even me personally, and I've got some more to talk about here, but even me personally, so far, I'm thinking to myself, okay, so if we don't get stimulus, who knows? Does that mean the Fed's going to pull out another, cat out of the bag, so to speak? Like, what else you got then? Which, in questioning, people kind of asked him that question. They're like, okay, well, can you do anything else? And he's like, oh yeah, we've got more ammo left over. So he's trying to soothe people's questions, and who knows if it's just all for the big dog and pony show. But the reality is, this is an organization that has over 2,000 economists working daily on trying to figure out what's going on in our economy. And just understanding that, okay, we're not going to see inflation go up until unemployment falls. And even if inflation goes up, it's not like they're going to turn the switch off on us. We've got some time. That's good. That's good for building our comfort to get into investing sooner. But I'm going to make some more conclusions and talk real estate and stocks in a moment. Let's keep going on here with what Jerome Powell said. On Main Street lending, he said the reality is we need more fiscal support. Like, he got drilled on the Main Street lending program and how some businesses just don't want it. And he started getting a little bit frustrated and defensive here, and basically kind of just said, call Congress. Congress needs to do something. In so many words, he literally spent 3 or 4 minutes being frustrated about the Main Street lending program and the lack of people using it. All right. Then he also mentioned that, and this is about when stocks started turning lower. When he started saying things like, look, airlines, restaurants, stadiums, entertainment, those are areas that are going to be challenged for some time, and we don't know how long that will be. He's making it very clear that we have no idea how long it's going to take for some of these recovery stocks to actually and realistically recover. We get all this volatility all the time. Yay, Delta Airlines. Yay, Carnival Cruise Lines. Oh, Delta. Oh, Carnival. All right, we get all that. But the reality is it's going to be a while before they're back to normal. He was even asked about a bubble. Is the Fed just creating a bubble that's going to pop? And he mentioned, it was kind of an interesting response. He said, everyone's been talking about a bubble basically for a decade, but the bubble pop hasn't happened. That doesn't mean it can't happen. And then he went into talking about how Congress needs to provide more support again when he was talking about commercial real estate. So some interesting dynamic, the way this press conference flowed. And this is the last one before the election. So this is a big one. So, okay, let's do some bottom line takeaways here. And how do we put all these pieces of the puzzle together? Because it's almost a little overwhelming, the amount of information he just gave us here. Well, I think the first thing that we really need to take away is we got to get our life insurance in as little as 5 minutes. We got to get our free stock with Webull when we deposit $100 because they're going to give us up to $1,600. And heck, we got to check out those amazing programs linked down below. One day that Labor Day coupon code will expire. I got to get rid of that. It's almost embarrassing now. So late. But anyway, Jerome Powell, bottom lines are that inflation will likely stay under 2% until 2024, possibly even longer. That's the thing. The way their dot plot shows is they just stop telling us what they think is going to happen past 2024. In fact, I'll pull it up right here. Take a look at this. See, what you'll see here is actually their projections, and you'll see this is rates right here at the bottom. And this 0.1, basically this is the interest rates at the Fed would be 0.0 to 0.1. And so they just put the 0.1 here. But anyway, look at this. 2020 is this line right here, 0.1. 2021 is this line. 2022 is this line. 2023 is this line. And then they expect rates to be 2.5% when? In the longer run. Well, when is the longer run? We have no idea when the longer run is. Well, that's the thing. The longer run could literally be 2026. Is it going to be 2024? All we know right now is it's not going to be until at least 2024 based on these projections. And Jerome Powell did say multiple times that, look, if things go bad between now and then, they will jump in and do even more because, again, they've got more ammo in the bag. And here's the inflation projection. Same thing. They don't even see inflation touching 2% until 2023 on an annualized basis. But even then, in the longer run, they don't even think that inflation will go over 2%. So it's kind of like, okay, so what's the point of the average inflation targeting, the flexible average inflation targeting? It ain't going over 2%. So it gives us a little bit more insight into sort of the minds of the Fed and what they're thinking and how we can plan. Really, remember the ways to invest in these low rate environments. In my opinion, I know margin loans are always so enticing, but gosh, lock in those 30-year fixed rate loans. But don't be anxious about it. See, this morning in my private live stream, I had, who was it? Oh yeah, I had somebody left a comment and they said that their agent told them that right now you should just buy anything, basically, get in and lock in your interest rate because rates will go up at some point in the future. They can't stay this low forever. I totally disagree with that. I don't think there's a rush to buy right now. I'm personally buying right now, but that's because I found a good deal. I found multiple good deals. So I would recommend, if you're thinking about buying real estate, get ready to buy and hunt for those good deals like I teach you, not only on this channel, but obviously in the courses down below. As far as stocks, I would just consistently keep nibbling in, especially on the red days, but limit the margin. If we get a big pullback towards the end of this year, because sometimes we get those, as people close out positions for the year, it'd be nice to be able to go shopping. So you don't want to have your credit card maxed when it's time for shopping season in the stock market. So fascinating. Good pressure on stimulus, in my opinion.